we have Mr. Henry Montag with us. He's an independent, experienced CFP and ABA author, concentrating in unique strategies for retirement and financial planning for almost 4 decades now. He's a co-author of The Advisors and Trustees and Guide to Managing Risk, author of over 100 professional articles and 100 professional presentations. So without any further ado, Henry, the floor is all yours. Thank you so much.
Thank you. And first off, I'd like to thank my CPE for for basically hosting as well as providing complimentary credits to everyone that could use them. I'd also like to thank our returning attendees. Last month, we spoke about the life insurance basics. Today, we're speaking about the living benefits. And next month, we'll be speaking about the state of affairs for the subject of the long-term care insurance industry. The Tully Center. Tully Center provides guidance to individual insureds, to the amateur trustee, which is basically the eldest son or daughter of your clients, as well as, of course, on up to the family office manager, as well as the individual advisor. Our objectives are basically to determine if a person actually has what they think they have, and then to help them maximize and obtain maximum value for their insurance. Today, my objective is very simply to expose you and make you aware of, well, basically 4 living benefit strategies within the realm of the life insurance industry that most of your clients and many of you may not be familiar with as well. What are living benefits of life insurance policy? Well, it's basically matching and selecting the death benefit or living benefit. And today, I hope to provide you with a brief overview of the long-term care industry, of the Pension Protection Act, which was the outcome of some problems in the long-term care industry, talking about some of the abilities of doing a 1035 exchange from transferring the cash value of life insurance over to long-term care or on to an annuity on a tax-free basis. The ability of the insured to sell a life insurance policy and being able to use tax deferral to supplement an individual's retirement. Do we look at a death benefit or are we looking at a living benefit? Death benefit, everyone's familiar with, provides family income, pays off debts, takes care of future tax liabilities, provides an educational fund, can also fund buy-sell agreements for business partners. Those are the ones that everyone's familiar with. But as far as the living benefits, not so much. Some of the living benefits we'll talk about are being able to pay for long-term care costs directly from the death benefit of a insurance policy on a tax-free basis. We'll be talking about the ability of being able to do, again, a tax-free exchange to pay for long-term care from an annuity or from a life insurance policy. We'll be talking about being able to sell a life insurance policy that benefits the insured, not the beneficiary. And we'll be talking about the ability of supplementing an individual's retirement through some of the advantage payouts of an insurance policy. Okay, so there's several reasons that people buy life insurance. They buy it when they purchase a house, they buy it when they have a child, a second child, a larger house, if they start a business, if they apply for a loan. We're all familiar with these when they want to create a legacy gift for the next generation, when they prepay their federal, state or state inheritance taxes. But the 2 that we're going to be talking about today, or other 2 that we're going to be talking about today, is when they set up a supplemental retirement plan, when they've maxed out on their 401, when they've maxed out on their defined benefit, when they've maxed out on their IRAs, simple SEPs, whatever it is, when they want to supplement what they've already got. And also when they want to use life insurance to pay for long-term care costs. Those are the basic times that people buy a life insurance policy. Life insurance is an asset class. Most clients aren't even aware of the word living benefits. Most clients don't use life insurance to pay for long-term care costs or expenses. Most clients surrender or lapse their policies rather than sell it. Most clients don't use the tax-deferred benefits of a life insurance policy to supplement their retirement. And most clients don't transfer their life or annuity gains to avoid tax forever into a long-term care insurance policy. Life insurance is an asset class. Policies for maximum death benefit, in which case we use term insurance, universal insurance, both non-guaranteed as well as universal insurance, as well as policies for maximum living benefit, which can include a whole life policy, an indexed universal, a variable universal, or even a private placement life insurance policy. And there are 6 different types of life insurance policies. Term insurance, which is the most popular, and we're all familiar with that. But the only problem with term insurance is that it only lasts for a period of years. At age 80, term insurance is over. The majority of people don't take advantage or don't do anything with a term insurance policy other than use it for the death benefit for a short period of time. It has no cash value whatsoever. A whole life policy, which is the second type, it's 100% guaranteed, and the client assumes zero market risk. In other words, the life insurance policy is guaranteed, and it forces an individual to accumulate maximum assets. It provides the least amount of death benefit for the most premium paid. Now let's just talk about cash value because everyone hears about it. But let's just take a quick example. Let's assume it doesn't matter the person's age or the amount of insurance. But let's just assume year one, there's a $10,000 premium. There are going to be some expenses taken out from that premium, basically to pay for commissions, to pay for the medical costs, to pay for the administrative costs of setting it up. Whatever those fees or expenses are, there's then a gross cash value. That cash value is guaranteed to grow with most policies at a 3% rate. Again, don't mind my math. It's just illustrative to show you that 9,500 can increase. At the end of a 10-year period, that same $10,000 premium cash value might be 90,000 plus the growth in the cash value. So we have 110,000. As time goes by, that cash value increases until the point that it's flush with against the death benefit. An indexed universal is the next type of policy. This is a policy that has the ability of building up some cash value, but it's not guaranteed. It can be made to be guaranteed, but primarily people put money into this for the accumulation purpose. But it is as I say, it can be guaranteed, and as a result, it's probably the best choice in terms of providing a maximum death benefit as well as providing a guarantee, with the opportunity of being able to perhaps earn a little bit more than you would on a other type of policy. But there's a give up for that. Rather than getting 100% of the gains when an individual invests in some particular type of stock index that they choose, rather than getting 100% of the gains, they only get 75%. They give up 25%. But what they get in return is there's a floor on their losses. In other words, the value only goes up. It cannot decrease. It cannot decline, regardless of what the chosen stock index that one has does or doesn't do. It's an excellent vehicle for maximum death benefit and for accumulation. A variable life insurance policy has no floors. Client assumes 100% of the market risks. If the value goes up, he gets 100% or she gets 100%. If the value goes down, they lose whatever it is that they lose. They lose 100% of it. They have 100% market risk. It's an excellent vehicle if you're planning on overfunding and putting in more money than one should. And many people do that. Something called private placement life insurance is similar to the variable universal, but you could just basically say that it's primarily used for the ultra and for the high net worth client. Non-guaranteed universal was a policy that didn't provide a guarantee, but provided maximum death benefit. And as years went by, as interest rates decreased, many people who had these policies, and it did make up approximately 55 to 60% of the market, as the interest rates decreased, they weren't aware that they should have been increasing the premiums. And as a result of neglect on the part of the owners, and as a result of reduced interest rates, most policies purchased years ago when interest rates were higher. The trade-off is that today the duration period, the coverage during that duration period has decreased, and many insureds were not aware that they should have paid a higher premium. As a result, an increasing amount of coverage is expiring years earlier, and we'll come back to that in a moment when we talk about one of the primary reasons as to why people are selling their life insurance policies. The last one is a guaranteed universal. It's got the best of all worlds. It's guaranteed. It's the least expensive. It can be guaranteed for a particular premium. It guarantees the duration, guarantees the death benefit, and guarantees the premium. Word about long-term care today. This was really one of the driving forces that that drove for a tax act called the Pension Protection Act, which allowed people to use life insurance to pay for long-term care costs. Long-term care today, it's literally one of the fastest growing individual and group benefits in the employee-employer marketplace. It has significant tax benefits because the government, as well as the insurance industry, have stakes in the game as to why they want people to purchase this. We'll talk about that in a few moments. Employers have the option of the discretion to discriminate. Pricing is now stable. The Society of Actuaries said that all the problems that we've had in the industry are now stable, and long-term care insurance is something that everybody wants, but most people think that it's too expensive, or they're afraid to buy it because what if I use it? What if I buy it if I never use it? But today, most new policies that are issued can add the long-term care insurance rider to its coverage. We're going to go over the subject of long-term care insurance in the next session, but I just wanted to put this slide up just to bring to your attention the various moving parts in a long-term care, in a traditional long-term care insurance policy. Insurance industry had many errors, incorrect pricing assumptions, incorrect utilization assumptions, incorrect surrender assumptions. In other words, they thought people would get rid of these policies after 2 or 3 or 5 years. They didn't think that as many people would be using them. They didn't have any any morbidity history, so they thought that they could just go ahead and say, well, we'll charge so much. But the insurance industry found the hard way that they had made some incorrect assumptions. And they didn't address the major consumer concern, which is, if I don't use it, I'll lose it. So why should I buy this? It led to significant bad press. It led to consumers' fear to purchase it because many companies had significant rate increases over the years, and it resulted in less than 9% penetration in the market. So it led to a need for other options. And with that, along comes the Pension Protection Act. It was a collaborative effort between government and the insurers designed to provide consumer price guarantees against rate increases, increase the private ownership of long-term care insurance. Why? So that the government wouldn't have to spend as much money when clients went to an attorney of sorts, to an attorney and an elder law attorney, and basically had their assets artificially impoverished so that they could qualify for Medicaid. If people would purchase long-term care insurance, then there would be less of a drain on the Medicaid system. And of course, the insurance industry had a significant interest in wanting to have people buy long-term care insurance because it's a for-profit motivation. So for the first time, the result of the Pension Protection Act allowed something called the hybrid or the linked or the combo life insurance to develop, and it could be used to pay for long-term care expenses directly from the death benefit of an insurance policy, tax-free. That was pretty significant. So life insurance can now pay for long-term care costs. Insurance purchases a policy, pays for long-term care costs from the death benefit. If, for example, a $1 million policy allows a 2% a month payout for almost 5 years, or a little over 4 years, actually. What that means, 2% of $1 million policy is a $20,000 a month payout for 4 years and 2 months. Or they have the option, if they needed to, perhaps if one needed to utilize the services of a skilled facility, they have the ability of taking out 4% payout or $40,000 a month for a 25-month period. Again, tax-free. Majority of policies today contain either a chronic care rider, where there are no upfront costs, or a long-term care rider, where there are some upfront costs. And again, for the sake of conversation today, I'm not going to get into the weeds, but I am going to just mention that there is a difference, and it's important to realize that difference. And with everything, with every strategy, with every product, there's some good points and there's some bad points. More to talk about that on an individual basis rather than just speaking generically. But the Pension Protection Act also allows tax-free exchanges on gains in an annuity. $2 trillion of annuity benefits out there. There are many people who've been holding these annuities. Many of your clients have been holding these annuities for years, and many of them obviously have significant taxable gains. For example, an individual purchased a $50,000 annuity. There was a gain over whatever it is, a 5, 10, 15-year period, doesn't matter, but there's a $50,000 gain. Prior to the Pension Protection Act, there would be a tax on that $50,000 taxable gain. Just use a number of 20,000, client walks away with 80,000 after they finally cash this investment in. However, after the PPA, that same $50,000 annuity that grew with the $50,000 gain is now no longer taxable. And there's now a $100,000 reward at the end of the day. And this could be transferred to a long-term care, which benefits the insured today. Just a schematic of prior to the PPA, you could, on the left side, transfer life to life, annuity to annuity, life to an annuity. Today, post PPA, you can now transfer an annuity into a long-term care insurance contract. You can now transfer the cash value from a life insurance contract that may no longer be needed into an LTC coverage. And QLTC is just basically a qualified long-term care contract into a traditional, which is not as significant. As I say, you can also, a schematic, just look at the gains on an annuity. An annuity can now be used to avoid all and any gains just by maximizing it, avoiding the taxes, and using it to pay for long-term care costs. How does the total living coverage work? Individual starts out with a $100,000 premium. They get for that a small death benefit, but the reason that they're purchasing this is to be able to maximize and obtain the largest long-term care cost benefit for that same $100,000, the 5-for-1. Now, you can purchase a traditional long-term care insurance policy, or you can purchase one of the new combos. You can't just assume or go with the hype and say, well, everybody's buying the combo. It may make sense, but it may not make sense. And the math is the science, and the math has to be done. And a comparison has to be made between what it would cost for a particular individual to either purchase a traditional long-term care insurance policy that would eventually have a $500,000 benefit available to be paid in the event of a claim. And you would have to compare that to a $500,000 combination policy that is basically a life insurance policy. Cost there is approximately $6,700. So the approximate cost to have this additional $500,000 of insurance in this case is approximately $3,000 additional dollars. One would have to ask, is it worth spending $3,000 to purchase $500? I think the answer is yes, as do many people who are making this comparison. But the fact is that many factors come into play, and one has to look at this on an individual case-by-case basis. But this comparison has to be made. Pop-up question 2, Jake.
All right, so the second polling question is up on the screens now. It says, when a person withdraws money to pay for LTC, it is. Please make sure to hit the submit button to register your responses here. If you cannot see the polling question, you can please answer in the chat panel. We'll consider it for the credits. All right, we'll keep it open for the next 2 seconds and we'll end the poll. Thank you so much, everyone, for responding. And Henry, it's back to you now. Thank you.
Thank you. Okay, so what do we do with an unwanted life insurance policy? Or another way to say it is, what happens when a life insurance policy becomes too expensive or when a policy is no longer needed? Well, let's come back to that slide that talks about why non-guaranteed universal life insurance is a problem. And let me explain a little bit about how this universal life insurance problem, which is responsible for the majority of people selling or those that become aware of the option, why in most cases this non-guaranteed universal life insurance policy is the problem. Prior to 1980, there were basically two types of life insurances. It was term and it was whole life, and that made up 100% of the marketplace. Interest rates, for those of you that recall, back in the 1980s, were upwards of 18, 19%. Actually, in 1981, interest rates hit a high of 21.2%. People were sitting with cash value life insurance that was earning 3%. And they were told, do you know that if you take that 10,000, 50,000, 300,000 cash value that you're earning 3% and bring it into the bank, not only will you get a 13, 14, 15, depending on the day, on the year, percent interest rate, but they would also be getting that General Electric toaster or microwave. And those electrical products had more money transferred from one bank to the other than did anything that I've ever seen. I was there back then, but it was unfortunately many in the insurance industry that poached on existing clients or existing life insurance policies and suggested, why keep that 50, 100,000, 10,000 earning 3% when you can go to a bank and get so much more? Well, it took E.F. Hutton to come along with the creation of a new type of life insurance policy, and that was called a universal life insurance policy. It was flexible. It had a premium that was significantly less expensive than whole life insurance. But there was one major problem. Unlike whole life insurance, which was guaranteed, universal life insurance did not have a guarantee. And if you just follow along on this slide, 55 to 60% of universal policies to this very day are not guaranteed. But over the years, when interest rates declined from the high of 21 to the low of basically zero of the last couple of years, the insurance company continued to bill the premium at the initial billing, which was 15, 20, 25 years ago at a significantly higher interest rate. So the premium remained the same, the death benefit remained the same. The only variable was that it resulted in a shortened duration of coverage. Now, it was the owner's responsibility to manage that policy, not the insurers, not the agent. I agree with you. There should have been more done on the part of the agent, on the part of the insurance industry itself. But please keep in mind that the insurance industry has a obligation to its shareholders, not necessarily to its insureds. And the insurance industry likes when policies expire or when the insured eventually finds out that the result of this reduced duration as a result of them not having increased the premiums and exercised a buy and hold rather than a buy and manage, results in policy and insurance faced with, I can't afford to pay that new premium, or screw you, insurance company, I don't want to pay that additional premium. In either event, most people didn't know that they should have, and as a result, the coverage is expiring prematurely today, and it's doing so on an alarming basis. As I said, the majority of people that use the services of a life settlement do so as a result of this non-guaranteed universal life insurance, when it finally comes to light that the policy is going to have a problem, and that the policy that people thought would last for the rest of their lives, or at least into their 90s. They're now finding that many of these policies are expiring when an individual is only in their mid 80s. And as we know, result of modern pharmacology, people living longer. So just as people living longer, their insurance policies are unfortunately decreasing sooner. I brought this to the attention of the Wall Street Journal, and I'm just going to be quiet for a second, just let you read this. This quote was used as an endorsement for the American Bar Association book, Advisors and Trustees Guide to Managing Risk. It's a real problem. So if there's a problem with the insurance policy, any experienced independent broker knows that there's several options that are available. One, an individual could either reduce the face amount. Naturally, if there's less coverage, the cost would be less. Or conversely, they could pay a higher premium, keep the same coverage, but just pay a higher premium. Or if they're healthy enough, they perhaps can obtain a guaranteed new insurance policy if they're qualified. Or they go ahead and sell the policy as a life settlement to an institutional investor. It's always a better idea to try to refurbish or re-engineer an existing policy, because in many cases, an individual is not healthy enough to be able to obtain a new life insurance policy to replace an existing one. In many cases, the problem can be a blessing if it's used, as we'll see in the next slide. But we can also use a combination of the above to be able to assist that insured with a problem policy. Most people will keep the coverage until the existing cash value runs out, which might be another year or 2 years. Some people will go ahead and just give up the policy to the insurance company to obtain the surrender value or the remaining cash value directly from the insurance company. Or a better alternative, if an individual is over age 70 in standard health, and if their policy has over 100,000 of coverage, they might consider the third living benefit, which is a life settlement. And you can basically then turn a bill into an asset. As an example, we had an individual who was 86 years old, had an $800,000 universal life policy with a $26,000 premium. Insured borrowed 100% of the cash value and the dividends were used to pay the premiums. Insured had, at the end of 30-year period, a $52,000 taxable gain, having I don't want to say never, but having not paid a premium beyond the 4th or 5th year. So they were covered. They paid the first several years of premium, and then they had a $50,000 gain, but they didn't have that gain because the policy was about to expire. So they used that gain to pay for the premiums. And now they're faced with an increasing premium of $29,000 required just for 1 year to go from age 87 to 88. And each year that premium would have increased by 5%. Insured had already paid in not a significant amount of money, but they didn't have the cash available to pay for that taxable gain and lose all the money that they paid in. So the option to do a life settlement and had two benefits rather. One, it stopped the life insurance premiums. 3, it avoided the phantom income tax that the client would have had to have paid, and in addition would have lost 100% of the coverage. Client was informed of a life settlement option. I ordered, and by the way, an individual to do a life settlement needs more than just the traditional insurance license. They actually have to obtain a life settlement broker's license. I was able to obtain a life expectancy report. And let me just talk for a moment, just what is a life expectancy report? Individual authorizes a life settlement agency, basically, to contact the insured's doctors and do a little bit of magic and determine, based on his or her age, based on his or her lifestyle, based on his or her medications, medical history, blah, 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 what their actual life expectancy may be. And the institutional investors use 2 of those as a means of determining whether or not it might make sense to purchase an individual's policy. In this particular situation, a life settlement offer was obtained from an institutional investor, and the client wound up accepting $188,000 as a settlement, whereas the day before he had a $29,000 bill to keep the coverage in force, plus a taxable gain of $52,000. I might add, before I went ahead and had the client accept or propose to the client that they accept this $188,000 offer, before any of that was done, it was important to re-engineer, or to offer the client the opportunity to perhaps re-engineer that policy. And perhaps if he didn't have the premium to pay for it, perhaps 1 or 2 or more of his children might. Keep in mind, if it's worthwhile for an institutional investor to make the purchase, then then certainly it would seem to make sense for a family to band together and to come up with the necessary premium if they want to assume the risk. Again, no one knows longevity risk, how long an individual will live. But the idea of re-engineering and offering it to family members before you sell a policy to an institutional investor, in my opinion, is a very, very significant and important thing to do. Also to avoid any secondary lawsuits from the beneficiaries to say, well, you sold my dad or my grandpa's life insurance policy and we knew nothing at all about it. So a life settlement is really nothing more than an alternate exit strategy when the death benefit is no longer needed. Another example, if an individual no longer has a need to pay for the estate taxes, whether it's because 2026 is coming around, the sunset provisions, or whatever the case may be, an awful lot more people are taking their life insurance that was going to be used to pay for estate taxes, and they're just saying, we don't need it anymore. We're just going to give it up. And they do. And they just get back the cash value. Or when a business is sold and a buy-sell is no longer needed because of whatever the reason, partners have sold the business, buy-sell no longer in effect, they just go ahead, take the cash value. Or when a business real estate mortgage loan is paid off, many times the term insurance will just expire. Meanwhile, if an individual is under, well, again, depending on the particular company, but if an individual is either under age 70 or 75, even with a term policy, they can convert that policy and sell it as a life settlement. So you can even take a term policy and, depending on the circumstances, turn that into a valid life settlement, an alternate exit strategy. This was an interesting situation. It just occurred a little while ago. Had a client, $5 million death benefit, 3 children. Family was doing well. They wanted to invest in real estate 9 months ago. And the client was 82. He mentioned to his attorney, because the policy was held in a trust, that he wanted to surrender the policy. What paperwork would they have to sign to be able to do that? And the attorney was smart enough to say, have you considered a life settlement? Client said, no, what's life settlement? I was introduced to the client. Client wound up accepting $1.8 million as a life settlement offer, full $500,000 more than he would have gotten had he merely surrendered the policy back to the insurance company. Majority of people will tell you that they weren't aware that there is such a thing as life settlement. No one told me about it. I'm not aware. And with that, the insurance industry is not obliged to tell people about the option of a life settlement. I don't want to mention the case, but there's been a recent case where Grill versus Lincoln National, where an agent and an insurance company was brought up on, why didn't you mention the fact that the client could have sold part of this policy when he no longer could afford it as a life settlement? And in court, the agent basically mentioned that I wasn't allowed to talk about it. The insurance industry is not necessarily interested in people continuing policies. They like when policies expire. As a matter of fact, it's a built-in profit center for them. So don't expect to get any help or a letter from the insurance company telling you, gee, this is a viable option. Why don't you consider it? Pop-up question 3, Jake. Jake, pop-up question 3.
Just a minute, Henry. There's some issue launching the polling question here. Just a second.
Sure.
Okay. So the polling question is up on the screens. Thank you so much, everyone. And please make sure to hit the submit button to register your responses. The question says, under what circumstances is it legal to sell a life policy? You have got 2 options here. Okay, we are ending the poll in the next 10 seconds. Okay, thank you so much, everyone, for responding. And Henry, it's back to you now. Thank you.
Okay. So what are the current requirements for life settlement? I say current because down at the bottom, something brand new just happened recently. Usually its requirement is 2 life expectancy reports. Usually it should be for an individual who's over age 70. Preferably the individual should be in declining health. Should be a minimum of $100,000 death benefit, and no term insurance if it's past the conversion date. Remember, some policies have a maximum date as to when they can be converted into a permanent policy. And it's unfortunate that so many people blow right past that date. And for a person who's healthy, it doesn't matter. But for the person that has some medical conditions, one of the best features of a term policy is that it has the option of being insured without asking any medical questions. It ensures future insurability. But what good is it if people aren't aware that it's in their policy? And trust me, there are many people with ill health that are sitting with term policies that are approaching the conversion age, be it 65 or 70, and they're not doing a thing about it. And it's usually, at some point afterwards where, why didn't I meet you earlier? Or why didn't somebody tell me about this sooner? It's a shame when the conversion age passes by a year or 2 and the individual would have liked to have kept that policy because he or she was unable to provide any additional coverage due to medical conditions. Currently, there's a new market for any type of a guaranteed universal policy. As I said, the majority of policies issued are of a non-guaranteed nature. But after 2003, 2004, the insurance industry turned to the guarantee as an option, the guaranteed universal policy. And at that point, many people paid a little bit more money, but they now have the peace of mind of knowing that their contract, that their coverage rather, was guaranteed. There are now institutional investors where they will consider an individual for life settlement at any age, at any stage of health. If the individual has a guaranteed universal policy, they'll very simply do the math. If it makes sense, they'll do the deal. If not, they'll say no, thank you. But for the first time, any individual now who's about to give up an insurance coverage, an insurance policy, and it happens to be a guaranteed universal policy, of which there are the majority of contracts sold today are of a guaranteed nature, and it's a option that should be looked at, and it should be considered in all situations. The last living benefit that we'll talk about today is what I call a SERP or SORP, Supplemental Executive Retirement Plan, or Supplemental Owner's Retirement Plan. Bottom line is that it's using a life insurance policy for its tax-deferred accumulation purposes, and its benefits are used to supplement one's individual retirement payouts. Again, term policies have no cash value, not used for this. A whole life policy is certainly used. An indexed universal that builds accumulation cash values can be used. A variable universal can certainly be used, as can a PPLI, a private placement life insurance policy, can certainly be used. And once the policies have matured, or once an individual has paid in enough money and now feels that he or she would like to withdraw some of those benefits, be aware that not only do we have the tax-deferred accumulation benefits during the accumulation phase, but through the use of loans and through the use of surrenders of cash value, as long as the policy survives the insured, those loans never have to be paid back, and the gains, even on the surrenders, never have to be paid back. They can be taken as tax-free distributions. There's a minimum reporting or administrative requirements for either a SERP for the executive or for the SORP, the owner of a business. There's the ability to discriminate among employees, and it's often used as a deferred compensation in large or small businesses. As you're probably aware, the majority of Fortune 500 companies all have these deferred compensation plans available to their high executive, for their top earning executives. So let's just take a quick look at an example of a $25,000 deposit over a 20-year period for a male, 45, and he deposits that $25,000 to age 65. In this particular situation, we have, I just took a net of 5.86, and the individual has an initial death benefit of $1,670,000. The income for having deposited $25,000 for 20 years at age 67, going on to age 82, is $77,500 some odd dollars. As long as the policy, as long as the coverage survives the insured, that gain is tax-free. And while the individual had a declining death benefit from 1.67 million down to age 82, he still has a death benefit of 257,000. There's no limit to the deposit. There's no limit to the period of time to defer the deposit, nor distribute. And I mentioned that courtesy of the Secure Act. And I'm sure many of you are aware that the Secure Act has significantly impacted the inherited IRA business, where an individual now, again, rules apply, but for the majority of inherited IRAs, there's no longer such a thing as holding it for 20, 25, 30 years. The maximum holding period now is 10 years. Government has spoken. Life insurance is one over and above the ability to defer money in a IRA, where there's a 10-year limit before 100% has to be distributed and taxes paid, to a life insurance policy, where, as I say, there are no limits, there are no time periods, and the income at distribution, as long as the life insurance policy survives the insured, is tax-free. So the insured gets back a total of $1,160,000 in life insurance coverage and never pays taxes on the $660,000 gain. So he's paid in $500,000. If you do the math, $77,596 for the years between 67 and age 82 is a $660,000 gain. Insured is able to walk away with that gain, never having paid a income tax on it, because there's a death benefit of $257,000 remaining on that policy. Not a bad deal. Private placement, it's just a more efficient way to accumulate. One can basically defer gains in any type of permanent policy, but PPLI is an institutional product, and it's a more tax efficient way to accumulate and distribute assets. A way I like to look at this is just to say, just add a zero to that 500,000 policy, or to the $100,000 premium, and it's an asset that's tailor-made for the ultra high net worth individual. It's a security, it's a private security, so there are some legal fees, there are some setup costs, but for the right individual, it's well worth the additional costs to obtain the additional significantly larger tax deferred status, as well as, of course, the death benefit that, if it's set up properly, passes both income as well as estate tax free to the beneficiary. Okay, so the private placement life insurance is a death benefit vehicle as well as a prime accumulation vehicle, and should be used accordingly. Again, in summary, life insurance is an asset class, and most clients aren't aware that these living benefits exist. Now, I'm not going to repeat myself on these same items that I mentioned earlier, but do you suppose that there's anything that you or a client could do to maximize the living as well as the death benefits of either your or an existing client's life insurance policy? I think so. Many of the items that I spoke about today come from the life insurance policy crisis, Advisors Trustees Guide to Managing Risk. This was the ABA's title, not mine, but they published it, so they had the choice. Along with a copy of the PowerPoint, I did submit a handout of 3 or 4 Bloomberg and Accounting Today articles germane to the topic that we just discussed. There's a March article on the living benefits of life insurance, where I just basically covered the 4 points that I just covered today, but it's in a 4-page Bloomberg article. Several other articles. I'd suggest that you download those, take those with you. Again, Tully Center is, trust-owned life insurance. Whether I work with trust-owned life insurance or individually owned life insurance, it's the same option. It's the same mechanics. It's just a function of you, the advisors, notifying your clients that there are dangers as well as opportunities. And the only way that he or she can take advantage of those is to first become aware and to see whether or not they can be maximized. So with that, let me open it back to Jake to see if there are any questions. And I think we have about 4 minutes left. So if there are any questions, I'm happy to take them. If not, I have a couple of questions.
All right, Henry, let me check if you do have any questions here. Okay, we have a question in the Q&A panel from Mary. It says, can your firm work with a resident of Bermuda who worked in US and owns a variable UL policy issued by US insurance company?
Yes, the answer is yes.
All right. There's one more question. If you inherited an IRA post 2020 and it has been deposited in your inherited IRA, can you purchase life insurance with money in the inherited IRA without paying taxes?
Not, not only can you, but it's, I don't mind mentioning the name Ed Slott, wonderful authority, but I know that that happens to be one of the strategies that he suggests wholeheartedly. So not only can you, but it's one of the smartest ways of using your RMDs to turn a taxable dollar into a leveraged tax-free dollar. So the answer is yes.
All right, so I cannot see any more questions here. Let me check if you do have any questions in the chat panel. Okay, policy proceeds for insurer. Okay, I cannot see any more questions here. Okay, so I cannot see any more questions here. Folks, if you have any questions, please let us know in the Q&A panel or the chat panel. And we'll let you know the answers. Okay, so Henry, do you have any closing comments here?
Yeah, I do. So much to be able to talk about, but the bottom line is you, the folks out in the audience today, the CPAs, the attorneys, you are the only choice, that you're the only defense that a client has, because most clients think of life insurance in the old days. They buy the policy, they put in the bottom left-hand drawer and they forget about it. But there's so many opportunities to reintroduce a client, to make sure that they actually have what they think they have, or to help the client take advantage and maximize some of the options that they're heretofore unaware of. So the point is that I know you guys are busy. I know you guys are tied up. I know you guys have your own issues, but think about just mentioning to your clients, when was the last time you had a second look at your existing life insurance? It might seem funny to do that the first 1 or 2 times, but when you get a couple of clients coming back and thanking you because they were able to receive more money from a life settlement, or because they were able to convert a policy that they would have otherwise missed, or to be able to, just everything that I just mentioned before, the thanks come in, and it's worth making yourself a little bit uncomfortable. And for that reason, I suggest Totally Center is a pretty good resource. Use this as a resource. We do charge the client a fee, but there's never a fee to an advisor. So take advantage of the service. Take advantage of Totally Center as a good independent resource center. And while people may not like to ask questions online or in a webinar or a live presentation, pick up the phone. It's right there. I promise I won't tell anybody else the questions you ask, but you will get some answers and you will pick up some additional information, which can be good for you as well as for your client, especially if you have any of the advisors out there have a group term policy. Consider, just shoot me an email and just ask for an article that I've written on the benefits on the detriments and benefits of group term insurance. You will be amazed, as were so many people that I've mentioned this to. I could go on, but let me just hold it from here. It's already 4 left of 4. So if there are no further questions, I'll just say thank you, and thank you to the audience.
Thank you so much, Henry.
Don't forget to download the handouts.
Yeah. All right. So thank you so much. And this was very informative and one of the most insightful webinars. And we're glad to have you on our platform. All right. So we have no more questions here. Okay. All right.
Thank
So
you.
lastly, for all the users, an evaluation form shall be sent within 24 hours to only those attendees who have answered all the polling questions. And it is required for you to complete the evaluation form in order to receive the credit certificate. We would request you to rate the webinar and provide us the feedback about the platform, speaker, content, and the webinar in the chat panel as well as in the evaluation form. Also, you can follow us on social media so you can stay updated about our latest webinars and industry information, and also share it with your colleague. Okay, so we do have good comments here. It's like excellent presentation, super presentation. Thank you. Thank you so much, everyone, for good comments. And lastly, if you need to view the recording of the webinar or if you have any further questions, please reach out to us at support@my-cpa.com and we would provide you the link to view the recording and will assist you further. Thank you so much for being such a wonderful audience. Keep coming back. Stay healthy, stay safe. Thank you so much, Henry, for coming, and we are glad to have you on our platform.
Thank you. Thank you, Jake. Thank you all.